All right, welcome to 4Thought's multi-method investing financial markets update. Our second session for today. What I'm going to start with, as usual, is a quick review of what has happened for year-to-date 2026 so far up through the close of business yesterday. And if you could just pan over here, please. So what you see here is a list of the market indexes, major market indexes, and what they've done from January 1st up through the close of business on June 17th, which was yesterday. If we look at the broadest measure of stocks, which we're calling world stocks, is the FTSE Global All Cap Index, which includes U.S. large, mid, and small cap stocks, as well as international developed large, mid, and small cap stocks, as well as emerging markets large, mid, and small cap stocks. So it's a very broad measure of stock market performance around the world. That has done 11.67% for the year up through yesterday. If we break that down further, we can look at U.S. large cap stocks. Here we're using the S&P 500 index. Has done a positive 9.01%. U.S. mid-cap stocks in the form of the S&P 400 mid-cap index has done 14.12%. In small cap stocks in the U.S., we have the S&P small cap 600 index has done positive 17.56%. In international developed market stocks, we have the MSCI EFA index has done a positive 10.84%. Emerging market stocks, we have the MSCI Emerging Markets Index up 28.03%. In terms of bonds, we have U.S. short-term bonds. Here we have the Bloomberg U.S. aggregate 1 to 5 year total return index, which includes corporates, treasuries, and agencies of 1 to 5 year maturities, has done positive 0.28%, and U.S. aggregate bonds, which is basically the same index as the one I mentioned earlier, except that it goes out to as many as 30 years as opposed to only going out 5 years, has done 0.26%, so they're virtually identical. And then Treasury inflation protected securities in the United States have done a positive 0.79%. So bonds are pretty much flat, and they've been pretty much in this range for the entire year to date, whereas stocks have fluctuated quite a bit, but have kind of ended up back where they were before all of the turmoil in the Middle East. And one of the biggest things that you will notice here in terms of stocks is that with the recent rally, the most recent rallying we've had, and this was similar to what was occurring earlier in the year, what are traditionally considered higher risk stock types have been accelerating faster than lower risk stock types. So for example, small cap in the United States has accelerated faster than large cap stocks. Emerging market stocks outside the United States have been accelerating faster than developed market stocks, etc. Right? So our best performing asset type so far in 2026 is emerging market stocks at 28.03%, and our worst performing is the U.S. aggregate bond index which is basically flat at positive 0.26%. Right? So very wide disparity there between the highs and the lows, and everything else is in between. All right, so but that's just for year to date. All right, so now we're going to take a look at recent history, basically the last 2 to 3 years, to put everything in perspective for you. All right, so going back to October 13th of 2022, that was the bottom. And I know this is difficult to see in the graph here. I will explain everything here in pretty good depth. All right, so going back to October 13th of 2022, that was the bottom of the last bear market preceding the most recent one, right? And that bear market ended October 13th of 2022, and we then went into a bull market which lasted up through February 19th of 2025. So that lasted a total of 2.35 years, and we had a cumulative gain during that time period of 76.06%. Also during that time period, we experienced what was called an eagle market, which we're not going to go into depth on that one, but I'll talk about that in a few minutes because we have just experienced a new one recently. Excuse me. On February 19th of 2025, we reached a new bull peak, right? So that was the peak of the previous bull market. We didn't know that was a bull peak, right? Because you never know until in arrears when a certain market environment is indicated or whether it's over, right? Because certain numerical thresholds have to be met in order to determine what happened in the past is or is not what you thought it was, right? All right, so, or to give final determination if that's the case. All right, but on February 19th of 2025, we reached a bull peak. We didn't know that was a bull peak until April 7th of 2025. So, roughly, a little less than 2 months later, because during that time period, we went into a bear market. And the bear market was very short-lived. And it was a bear market being a market environment where you get by technical definition, a cumulative decline of 20% or greater. And here we're using an intraday definition, from an intraday peak to an intraday trough, right? So from February 19th of 2025 to April 7th of 2025, we saw a cumulative intraday drawdown of 21.35%. Just so happens that when that happened, all right, so then we knew, okay, a bear is confirmed. We've seen a drop of 20% or greater. Then we knew this was a bull peak. So that bull market was over on February 19th of 2025. We also knew we had been in a bear market starting on February 19th. What we didn't know at that point, which we would later find out, is that was also the trough of that bear market, right? So the trough ended up being the same day the bear market was indicated. So it turned around on the same day we hit the 20% threshold, it turned around and went straight back up on the same day. So that is an extremely short-lived bear market, right? And it was just barely a bear market. And in fact, if you had measured this on a closing price only basis and not on an intraday basis, then this would not be considered a bear market, which is why you probably didn't hear a lot about this on the news, because I guess most people were not paying enough attention to the actual numbers here, right? So even professional analysts, right? So, but we did hit a bear market threshold on February 7th of 2025, and we knew that was the trough of the bear market, not, again, similar to back here, you don't know till, you only know in arrears what market you've been in or when something is over. But on June 27th of 2025, so about a year ago, we had a bull market indication, right? And bull market was indicated because what was then the record peak from February 19th of 2025 was re-achieved. We had this very fast V-shaped recovery, right? From February 19th of 2025, we then had a maximum drawdown, 21.35% of April 7th, 2025, and then a V-shaped recovery. We re-achieved the prior record on June 27th of 2025. So we now knew at that date, okay, we had been in a bull market at least since April 7th of 2025, right? Since then, everything else really now becomes a question mark. These are all the things that are fully confirmed, right? Because they happened in the past. Going forward is where all the question marks lie, and that's where the analysis comes in. All right. So since June 27th of 2025, what has happened is we've had continued growth from that point, right? And we reached what at the time was a new record price on January 28th of 2026, so earlier this year, right? At that point, that was on a Friday. The following Monday, I believe that was a Friday, following Monday over the weekend, all of the military action in Iran and the Middle East began, and we saw this this drawdown that ended on March 30th of 2026. And the cumulative drawdown during that time period on an intraday basis was 9.79%. So it was just shy of a technical 10% correction. We did not get a full 10% technical correction. All right. From that point forward, we, again, very rapid recovery and extension beyond the prior record from January 28th, all the way up through June 2nd of 2026, just a couple weeks ago. So as of right now, the all-time record high on the S&P 500 index was on June 2nd of 2026. Right? Since then, what has happened is we've seen a maximum drawdown from that point of 5.03%. That was on June 9th. Right? And then we've seen a partial recovery back up towards that prior record high. As of the close of business yesterday, we're down 2.63% off of the prior record from June 2nd of 2026. So that's where things sit right now, or as of the close of business yesterday, I should say. I don't even know what it's looking like right now, but we can come back to that later. It's largely irrelevant because we're not really near any particular threshold. Unless there's
green on the screen, but
yeah, unless there's a major move today, we're not going to break any new thresholds right now. Okay, so what does this mean more in depth? All right, so let's look at what do we know about the situation so far, and then what does history tell us? So what we know is that from the point of bull indication on June 27th of 2025 up until June 2nd of 2026, we have not had any 10% technical corrections, right? We have not had any 10% technical corrections since April 7th of 2025 either. So we have been in a bull market at least up through June 2nd of 2026, right? At least up to that point. What is happening since then? We don't know, right? But at least through then. And actual measurements from June 27th up through June 2nd of this year, so a little less than a year, it's 11.33 months have elapsed, and we've had a cumulative gain during that time period of 23.97%. Okay? Looking at it differently, if we look at it the full duration of the bull market so far, this new bull market so far, from April 7th of 2025 up until June 2nd, there we've seen 1.15 years have elapsed with a cumulative gain of 57.62%. All right? So, yeah, the cumulative gain is roughly double that of, more than double that of the gain since the bull indication. What also has been confirmed during this time period is something we call an eagle market. Now, an eagle market is indicated by a trailing return of 30% or greater, 1 year trailing return of 30% or greater on the S&P 500 index without any 10% plus intervening corrections, right? So rapidly rising asset prices with low volatility. And that was confirmed on April 8th, so basically exactly 1 year after the 4/7/25, right? And it has lasted at least through June 2nd of 2026, the most recent record high. What has not happened during this time period, although we came very close, right, from January 28th to March 30th of 2026, is a 10% plus technical correction. We got close at 9.79% drawdown, but we didn't break through the 10% threshold. And why is that important? Because what we're looking for right now, I'll come back to this for reasoning on this, what we're looking for right now is something called a wolf market. A wolf market is, by our definition, an environment of heightened volatility with no real clear bull or bear trend, right? Just conceptually that is what it is. On a quantitative basis, it's defined as a period of cumulative decline of 10% or greater, but not 20%, so not quite a bear market, right? But a correction, 10% plus correction or greater, but not a bear market, plus the recovery prior to the pre-correction peak, right? So the V shape, right? And it doesn't necessarily have to take the shape of a V. It's just what it can squiggle around in any different shape, but the correction plus the recovery, right? So we almost got there here, but not all the way, right? Okay, so that's what's happened so far, right? We know we're in a bull market and an eagle market from the point of April 7th, 2025 to June 2nd of 2026. We know that at least. What do the things look like going forward? What can we expect? Well, history has potentially some answers for us. If you could put it over here, please. All right. So if we look at the history of the financial markets, in particular here we're talking about the S&P 500 price return index since 1950. We've done extremely extensive internal research on this subject. You can read our published white papers on our website. So please take a look at those at 4tfg.com, the numeric 4. But in summary, everything we're seeing that I'm going to tell you right now is effectively an explanation of what we do with our algorithmic portfolio management processes every day, right? We do this on a computerized, partially automated basis every single day. This is just kind of an explanation of what this morning's analysis told us, right? Okay, so bull markets after indication to peak, right? So that means in our example here, June 27th of 2025, up until so far, June 2nd of 2026, right? If we look at, if we were to assume this is the top of the current bull market and we then were going to go into a bear market, that would be the equivalent of what we're talking about here, right? It's not what we're assuming, but that's not what we're saying, but that is, under that assumption, after indication to peak, historically, if we look at all of those, the bull and bear markets in history, the shortest time period before a new peak was reached was 6 days, and the longest was 7.44 years. All right, so very widespread, but the average comes in at 2.19 years. So the average time between when a bull is indicated and the next peak occurs is 2.19 years. So far, we've seen 11.33 months occur. So less than half the average. In terms of the gains during that period, they ranged from positive 1.5% to positive 221.97%, with an average of 49.75%. So far, we've seen additional cumulative gains of 23.97%. So again, less than the average gains, so less than half of the average gains during a bull market. Another perspective you can look at it from is from trough to peak, right? Not from indication to peak, but from trough to peak. So from 4/7/2025 to 6/2/2026 in concept, if you assume that was the peak. Probably is not, but here's if it were, here's the comparison. So looking at the history of bull markets, the shortest one in history was 1.15 years long. The longest was 9.55 years long, and the average is 3.97 years, so about 4 years is the average length of a bull market. In terms of the gains during a bull market, the smallest ever was 44.62%, the biggest ever was 341.05%, and the average is 128.07%. What we've experienced so far is a duration of 1.15 years, right? Which would, if it just so happens that would, if it turned around right now, that would be exactly the same as the shortest bull market ever, right? And we've seen a cumulative gain of 57.62%. Right, so we're talking about versus 128.0%, 07% on average. So we're talking about, again, less than half the average gains during a bull market. So both of those things together tell us that it's unlikely that we're getting close to a new bear market at this stage. Right, if you look at it based on historical averages. Other things to consider, however. So bear market corrections and troughs, bear markets and correction troughs, and the average time to a new bull market or wolf market peak, right? So basically we were looking at not just bears and bulls, but also corrections and new pre-bull peaks, right? As another way of putting it, right? So if we look at those, we're looking at and the history of all of them going back to 1950, which is the longest possible data set we have because the S&P 500 didn't exist before then, other than through backtesting. The shortest time period of history was 1 day, right? After a peak, did we go into another decline? And the maximum was 5.62 years. So again, very wide range. The average comes in at 1.1 years or 13.38 months if you average all those together, of which there are many instances, right? That's important for which because for reasons I'll come back to in a few minutes. Other things to consider: wolf markets during a bull, right? Throughout history, there have been a range of 0 up to 5 wolf markets, which are basically a subset of the broader bull market during any given broader bull market, right? Anywhere from 0 to 5, with the average being 2 to 3, right? So far, we have seen 0, right? And there's actually only one time in history where there was no wolf market during a bull market, and that was the period from 2018 to 2020, right before the coronavirus crisis hit. So that's the only time it's ever happened, right? So it's an unlikely scenario, especially unlikely for it to happen so close after it already happened, right? In most cases, it goes significantly longer. There are multiple wolf markets during a bull market, and there happen to have been many instances of 5 or more during a broader bull market. Okay, other things to consider so far, again, 0 have happened, right? Eagle markets during a bull market. The average or the low end, there's always been at least one. There's never been an instance of without one. And the maximum has been 4. The average is 2, right? In this case, we do have confirmation of an eagle market, right? So we have at least 1 so far, but the average is 2. So we're still below average on the number of eagle markets. Okay, other things we consider here, right? We're just looking at what we call historical market type data analysis. Historical market types being bull, bear, wolf, eagle markets, right? And basically the measurements of those. Other things we consider is we look at things from a probabilistic analysis standpoint. So what I mean by that is, like, so for example, all these, what do we have there? 9 different asset categories, right? We do something called quantitative probabilistic analysis on those. So basically what that means is every single day, part of our algorithmic processes are to create and measure distribution curves for each of these different asset types, right? And we compare those distribution curves not just to their own history, but also to each other, right? And the reason we do that is we wanted to determine which asset types or asset classes are over or undervalued relative to themselves and relative to all the other asset types, right? If we do that, we can look at stocks. If you could get down here a little bit, Mick, please. So if we look at stocks, stocks currently are ranging as of this morning anywhere from slightly overvalued to moderately overvalued. So slightly overvalued in our mind would be anything from a half standard deviation up to positive 1 standard deviation above their long-term average. Whereas moderately overvalued would be anything from positive 1 standard deviation to positive 2 standard deviations above their long-term average. Right, so that's where most stock types are sitting right now. With bonds, most bond types are measuring anywhere from near fair value, so near the 0 mark, near their long-term average, right, up to slightly overvalued. So just like I said, anywhere from a positive half standard deviation to positive 1 standard deviation beyond their long-term average. Right, so everything's looking anywhere between fair value to moderately overvalued. So yes, it's on the positive side of things in terms of being overvalued, but it's not significantly or extremely overvalued, right? And things can remain on this basis either significantly or over or undervalued for extended periods of time, like happened during the time after the financial crisis, when the government was basically artificially inflating asset prices using the quantitative easing program. It's an example of where you can get like really extreme and long periods of significant overvaluations, right, can occur. There are other, that's just one example of how that can happen. Okay, so what does all this tell us? Right, so that's just a whole nother perspective we can use to analyze, right? In summary, what everything I just said right here, we had a bear market trough on 4/7/2025, which was the same day the bear market was indicated. We still good?
Yep.
Okay. Okay, going back. In summary, we had a bear market trough on 4/7/2025, the same day it was indicated. The bear market was confirmed on an intraday basis, but not on a closing price basis, which is why a lot of people didn't report on this. They missed it to some degree. We have the bull market, the new bull market, was confirmed on June 27th of 2025 last year, so a little less than 1 year ago, just barely less than 1 year ago, after an extremely rapid recovery, after the V-shaped recovery. We've now confirmed our first eagle market during the new bull market, right, as of April 8th of 2026, which has lasted at least through June 2nd of 2026. So the first two things I mentioned earlier, were telling us that, both looking at the perspective of bull markets after indication to peak and bull market troughs to peak, that we are still in the first half of the bull market on average, right? If you look at the long-term averages of bull markets, but we're probably getting closer and closer to the midpoint of the bull market. We're nearing the midpoint of the bull market, most likely, again, based on historical averages. And then lastly, a wolf market. This is probably the most important point. A wolf market is becoming more and more probable, most likely over the next 5 months plus, right? Reason being, we are now exactly 1.19 years since the bear market trough on 4/7/2025, and on average, the time until the next peak before a new bear market or wolf market is 1.1 years, or 13.38 months. So now we're beyond the average, right? And we still haven't seen the wolf market occur, which tells us that if we're still somewhere in the middle of the broader bull market, but we still haven't seen a wolf market, the most likely scenario, although it's not the only possible scenario, the most likely scenario is that we are going to get a 10% plus correction, followed by a recovery from it, and then re-entry into a bull market, and that will probably happen sometime over the next 5 months plus. Okay, so all of that being the case, how can portfolio managers and advisors take action, and how can the end user investor take action, right? Over here, Mick, please. All right. So some of the things we want to be conscious of that portfolio managers can keep in mind and take action on are that in terms of our broader stock market outlook, we can look at it from the standpoint of the short term to intermediate term, right? In which case we are moderately negative on markets for a couple different reasons, on stock markets in particular for a couple different reasons. The main one being that we believe we're getting closer and closer to a wolf market, which we have not yet experienced during this fall, right? Again, sometimes over the next 5+ months. Also, looking at both stocks and bonds look overvalued to some extent, although they're not heavily overvalued, they're not significantly overvalued, they're still overvalued and have been for some time period. So both of those are indicating that a potential, moderate downturn in the markets in the short to intermediate term. However, given that we believe this is likely to be a short-term phenomenon, short to intermediate term phenomenon, beyond that wolf market, we are still positive on stock markets into the long term, so the intermediate to long term, right? Because we believe the bull market will continue following that correction and recovery. So what can you do? You start preparing for the wolf market during the next 5 months. How do you do that? First of all, you overweight opportunistic investing, because I think I mentioned earlier, if I did not, opportunistic investing tends to be the type of investment management or the method that tends to outperform best during a wolf market, right? Because it has the capacity, the capability to capitalize on volatility, whereas none of the other 4 methods of investing, like liability-driven investing, strategic asset allocation, selective concentrated investing, none of those even have the capacity to do that, whereas opportunistic investing does. It's extremely difficult to do it, which is why you have to have a vetted algorithmic process that has worked in the past to do it and try to capture that. And you don't want to be putting all your chips on the table, to bet on opportunistic in the short term, because we don't know exactly when it's going to happen, and you could be missing out on upside during the ensuing time period or the intervening time period. But you do want to begin to start to overweight there, so that you do have at least some exposure to opportunistic when that does occur, and when that wolf market does occur. We are underweighting selective or concentrated investing. Part of the reason being that we already have confirmed an eagle market, and once you've confirmed an eagle market, that means it's probably pretty close to being over, based on history. So we're underweight there. Selective or concentrated investing tends to do best in the eagle market, and the eagle market is relatively close to over. We're neutral on strategic asset allocation and liability-driven investing, right? Because we are still probably in a longer-term bull market, like we said, nearing the midpoint of the longer-term bull market. And with liability-driven investing, we're still neutral on that. You want to have your appropriate allocation for your particular objectives set up there. The only caveat to that is, I would say that given the fact that we have already seen we're nearing the 1-year mark following indication of the bull market. Given the elapsed time since indication of the bull market, it probably is time to top up or rebalance into the liability-driven investing, which is typically your fixed strategic fixed income component. You want to top up that allocation up to the appropriate number, up to a maximum of 25% for anybody that has an allocation target of 25% or below, right? So that's the only caveat to that, is rebalance into it on the LDI side. Okay. In terms of looking a little bit more granularly for the portfolio manager or the investment advisor, relative valuations, if we're looking at our opportunistic modeling, are showing long-term U.S. Treasury bonds are the cheapest out there. whereas emerging market stocks look the most expensive. And that was kind of indicated earlier. It coincides with what's happening with the indexes for year-to-date 2026. So that's really what portfolio managers can do, and investment advisors can advise their clients on and help them with in their portfolio. That's not something that the end user and investor can really take action on. However, the end user investor can take action on some things. They can control their cash flow, right, in and out of their portfolio. And so for growth investors, what they'll want to do is very simple. You want to have a neutral systematic investment plan. Basically deploy, so meaning, if you do a personal cash flow analysis or income statement analysis, and you say, okay, my income is such and such dollar amount, my taxes are such and such dollar amount, my living expenses are such dollar amount, what comes out at the bottom is my annual savings. I divide that number by 12, and that's the number that I put into my systematic investments, into my portfolio each month. Right, that's the number that should be used. We don't want to be doing any more or any less than that, right? So it's neutral, right? And that can be into the 401k, to the non-401k assets, etc. Right? But into your managed portfolio. And any excess cash that you may have accumulated from quarterly bonuses or the sale of some asset or anything like that, that's beyond your short-term safety and liquidity fund, that cash can be deployed in lump sums normally now. There's no need to wait. There's no need to do it in any kind of dollar cost averaging program. There, at this point, systematic investing, but not dollar cost averaging. Two different things. As soon as you get that income from your earnings, invest it, right? Don't wait. Don't let it sit in cash, which would be more like a dollar cost averaging program, right? You don't need to do the DCA right now. There are times to do that. This is not that time. Okay. For income investors, similarly, just kind of the inverse of that is you want to be neutral on your withdrawals. Do the same analysis I mentioned earlier, but what comes out at the bottom is not your savings, it's your portfolio income need. Your portfolio income need should be the same thing. Your annual number divided by 12, that's what you take out of your portfolio on a monthly basis, right? Similarly, replenish cash deficiencies. So if you have a safety liquidity fund that for any reason has been drained, maybe you've had unexpected expenses you need to drain out that cash pile more than you would like, and you need to top it up. It's not a terrible time to do that. Replenish your cash deficiencies if necessary. There's no need to build some large cash pile in anticipation of some big drop in the market. That's not something you'll be able to take advantage of. That's not very likely to be the case in the near term anyway, or intermediate term either. That's only something really your portfolio manager or investment advisor would be able to do for you or advise you on if the time comes to do that, if we get a 10% plus correction. It's not something you'll be able to do on your own, because it's extremely time sensitive to do something like that. So that's really, in a nutshell, where you should be right now. That pretty much concludes what I have to say in terms of getting an update up through today. We'll see what happens going forward. This is not a huge change from our update really from last month. It's relatively similar. The general guidance is the same. It's just that more time has elapsed and the numbers are slightly different. That concludes my update. I will tell you that for those of you who are not familiar with what we do at 4Thought Financial Group, we are a fee-only SEC registered investment advisor, independent. We do not have any affiliation with any larger companies that force us to sell their products or tell us what to do. We are independent completely. We have three primary services, which are investment advisory services, in which we utilize some of the analysis that I'm talking about here today in the form of algorithmic processes. And we have 10 different separately managed account strategies, which are private managed accounts that we manage for you, which are rated and ranked by third-party rating agencies like Morningstar, for example, which currently give us a 5-star rating in 2 of our strategies out of 5. a 4-star rating in 5 of our strategies, and 3-star and 2-star ratings in the remaining 3. So if you look at that compared to the field of investment managers out there that are being rated in this way, I think you'll find that it is an extremely favorable firm level analysis or ranking of what we do. So if you're interested in that, please contact us. That's one service we provide. A secondary service that we provide is retainer fee-based financial planning, in which we do not just your investment portfolio management for you, but we also do investment planning for things like retirement planning, educational accumulation planning. We do your estate planning analysis for you, in which we look at gifting programs, wills and trusts, etc. We do business succession planning for business owners, what happens to your business in the event of retirement, disability, or death. And we do fringe benefits planning, so looking at 401k, pension, defined benefit plans, non-qualified deferred compensation plans for business owners and employees, and coordinate all of that for you. And we do that on a fee basis. So removing as much bias as possible, being objective as possible in management of your financial life. And then lastly, the fringe benefits brings me to our third service set, which is retirement plan services. We have a retirement plan services program for business owners, in which we come in and install 401k, profit sharing, defined benefit plans, etc., so qualified retirement plans, and we manage those programs soup to nuts as a 338 fiduciary investment manager, in coordination with a third-party administrator who will do the tax filings, etc. So if you have any interest in any of those for yourself or for your clients, please contact us at 4Thought Financial Group. That's 4tfg.com with the numeric 4. You can email us at info@4tfg.com and contact us at 516-300-1617. Thanks very much, and we'll see you on the next update.